Hi everyone, welcome to this new video where we'll be studying SBI Life Insurance Company. The company, as you can see, is in the financial services industry and more specifically life insurance. And the sector ranks are not looking that good. It's just in the top 44 percentile. But what I will say is that if you actually go on this leaderboard, and the rankings are calculated by using the blended scores, it is definitely higher up than HDFC Life, which is lying at 15th number, right? So it's definitely better than its other peer on the portal. And another thing to note here is it's only one of the two companies which has been categorized with a wide moat. And we will understand the reasons behind this as well. But what I'm trying to say here is that maybe, yes, the industry ranking is in the red, but it's maybe not doing justice to this company, maybe, right? We'll also see the business snapshot. ULIPs are at 59% contribution to the revenue, which is very similar to HDFC Life Insurance. Moat analysis we'll get into, as I already told you, it's got a wide moat. We'll study the key variables to understand if those numbers are kind of reflecting the story that we'll make up for the company today. Quarterly scores, one of the few companies which has reported numbers for this quarter. The rank has been mid, I think, the result was 7.8, so it was a good result, right? There have been better results also in the financial sector. Nippon Life Management, AMC, has got a good score. It's HDFC Life Insurance has actually got the worst score this quarter, but we'll understand the quarter score as well a little bit, and we'll dive into the growth prospects of the company. It's got a decent average score, relatively it's an average score on the portal. And the guidance tracking also, the management has been said that it's a highly trustworthy management, specifically in respect to giving guidance, right? Which is actually, well, it's not that difficult. This company grows at a modest pace of 13 to 14%, and that's the guidance that they give. And if it's not going to be there, they will downgrade their guidance. So it's I don't know, yes, it is high trust, but at the same time, management is kind of changing their course if the future looks like it's gonna be different, right? So then how do you really trust their guidance if they're allowed to keep changing it as new things emerge? But anyway, that's what the portal is telling us, and the revenue is, as I said, companies on a 13 to 14% growth trajectory, and that's what the revenue even for FY27 will be. We'll get into it, right? But mostly I will skip the industry and subsector discussion because it's very similar to our video on HDFC Life. So I will go straight into the business segments, the business snapshot, having under the base assumption that you guys are familiar with how the insurance industry works, right? So if you see the business the revenue distribution, ULIPs are 59% of the revenue, non-par are making up 28%, protection, that is life insurance, is making up 9%, and then group insurance is also making up 4%. What's very interesting about this is, and I think we discussed it, maybe we didn't discuss it on the earlier video, but the margins are very different for these products. This is like a 15 to 18% margin business. Non-participating is almost a 35 to 40% margin business, and protection is almost a 60 to 80% margin business in a very general term. So when the product mix changes in such a company, the margins get very, very affected by it as well, because the gap between the margin is huge. So that is something very interesting about the company, right? And we'll get into some of the trends when it comes to their revenue next. Alright, so if we move on to the revenue trend, Well, what has been given here are some synonymous metrics which can be used to better judge a insurance business, which is the embedded value, the total annualized premium, and the value of new business. Well, what we are basically seeing is that everything is in green, everything's growing at a double digit, 10 to 20% number. So there really isn't much to take away from this revenue trend, other than the original story that we have developed, that this is like a mid double digit, like a 13 to 14% growing business, and that's also what is being reflected in their annualized premium and value of new business, some metrics which we discussed or understood in our previous video. If we look at the mix shift, this is where things get interesting. One of the things I'm noticing is ULIPs went up. They were in green for 23 and 24, but then they've gone to red on the next 2 years. Whereas non-participating, the opposite has happened, where they have gained some share back, right? And this is kind of the story which is playing out with SBI Life Insurance, that they're kind of trying to move away from a very high ULIP concentration, which went up to almost 70%, right? And ULIPs are also the lower margin businesses, right? So definitely we can see the story that this company is moving towards less concentration in the ULIP segment and trying to increase their concentration in the non-par and participating, and now even in the protection, they want to increase their mix, right? So what this mix shift will also lead to is a margin bump up, because these products, these segments are higher margin businesses. So if this plays out, this is something we could see, although the margins have held steady for the last couple of years. When this transition has played out, we'll see that very soon, right? Because I think, which is a good sign, because there have been other headwinds in the industry. So managing those margins is almost similar to basically having a margin improvement, right? So this is some interesting takeaway from the business analysis. If we look at the moat, this is given a wide moat. There have been confirmed excess returns at the very best end of the bracket. Industry leading 12.9% 3-year premium growth and a healthy 27 VNB margin, right? The moat is primarily driven by a massive scale-based cost advantage and intangible brand assets derived from its parentage, SBI, the State Bank of India. The bancassurance channel provides an exclusive low-cost distribution funnel. So this will be very interesting, where we'll see the bancassurance a percentage of the channel mix, and we will also see their lower cost because of it as compared to other peers in the variables very soon. A wide moat is justified as the business has been cycle tested over its 25-year history. The gatekeeper test is clearly no, because a well-capitalized attacker cannot easily break the trust and physical reach of the distribution model, right? So yeah, you can read more about, maybe the light got, but you can read more about the moat analysis, but definitely it's been given a wide moat due to the brand, due to the cost advantages in terms of distribution. Switching costs are also there, because it's very tough to end an insurance policy and go to another one. There's some laziness which even I experienced in that terms, and I kind of paid 1 or 2 more premiums than I wanted to. So there's definitely some amount of stickiness which comes into the picture. But yeah, next we'll discuss the key variables of the company. Right, so if you look at the key variables, the VNB margins have held their course, right? They peaked a lot in FY23, but if you look at the FY22 benchmark, they have kind of maintained their margins in a 27 to 28 band, right? which is, I would say, is really good. The persistency is increased. More people are following up on their premiums the next year. This is a good sign. VNB margins, I would say, is a good sign. Bank assurance versus agency channel mix. This is a good sign as well, because what we are seeing is the overly dependence on bank assurance as a channel has been reducing, and the agency share has been increasing, right? So in future, if there is an open architecture which is brought on as a regulation, where basically the banks have to be very fair and equal in terms of offering life insurance to its users, then SBI will lose the priority access that it has to SBI Life Insurance will lose the priority access. So although that's not happened yet, but it's good to kind of move away from an overly dependency on bank assurance channel. So this is also a metric which is going in the right direction. Operating expense ratio kind of has increased, but what's really important is there are some short headwinds which are being faced. So it going up is understandable, but yet with the peer range being in 8 to 10%, what is evidenced here is that still SBI has some cost advantages to its peers, which are not going away anytime soon, right? Return ratios, if you see, it's held in the same narrow band for 5 years. The gradual moderation reflects a peak here. So yeah, there's nothing to worry about in terms of the return ratios as well, and that's what is basically popping out from this key variable analysis, that well, nothing is going very wrong for this business. At the same time, certain things are improving: persistency, agency channel mix, right? Even VNB margins, if you see, underlying margin X regulatory disruption is roughly 29%. So that's also on the right track, right? So that's the picture that we want to take away from the variables, right? That overall things seem to be going well, and there's nothing to really worry us about. In terms of future growth, it's got a 7.8 score. Obviously, the agency distribution network ramp up will be an important factor. They want a structural product mix shift to protection schemes, right? So they'll want their agents to kind of sell more protection schemes, which is the higher margin business, right? So these are some of the catalysts, these are not catalysts, but this is just the general strategy or the general direction in which the business is heading, right? This is not like a capex catalyst where suddenly new capacity comes online, right? This is the general direction which the company is heading into, and that's what we also see in the base case, that they'll continue growing at a 14% base case if it sustains at the historical mid-teen levels. Right, there's a high confidence in this as well, as compared to some other companies where the modeling has shown percentages with some lower confidence. And quickly, if I see the guidance, the guidance was in line. This year they kind of reduced it from 15% to 13.5%, and I think this is what they're also saying for FY27. So basically the credibility has been given high trust, exceptional reliability by delivering the margins exactly within their tightly defined range, right? And they intend to maintain the growth rate of approximately 14% over the next 5 years, aligning with their historical 3 to 5 CAGR performance, right? So it's a very linear story which has played out and which might play out for SBI Life, right? So yeah, interesting company, might be undervalued currently, but yeah, that's the story of the stock.